We are sitting in the absolute eye of a structural macro hurricane. It is the systemic, multi-layered capital reallocation of 2026. We are witnessing three distinct architectural trends colliding at once. 1. The geopolitical relief valve. Global liquidity is aggressively repricing risk as the Middle East conflict hits a structural de-escalation phase. 2. The AI crypto capital war. Large-scale institutional asset managers are actively treating decentralized networks and artificial intelligence ecosystems as a direct binary trade, rotating capital out of slower software protocols and moving it straight into high-performance compute infrastructure. 3. The pure app chain dominance. The retail and quantitative volume on platforms like Hyperliquid proves that the market has officially discarded ideological purism in favor of hyper-performant fee-generating cross-asset execution layers. Today, we deliver an extensive, institutional-grade deep dive. We break down the precise mechanics of the $65,000 Bitcoin rebound, expose the hidden structural trap keeping Ethereum suppressed, and map out the exact operational realities of the decentralized app chain narrative. This is the Signal and Noise podcast. My name is Newell. Make sure to like and subscribe. Let's dive in. Let's first dismantle the primary macro catalyst driving the immediate price action across both Wall Street and digital assets. The unexpected, definitive stabilization of the 4-month conflict between the United States and Iran. To the casual retail observer on social media, a peace agreement is simply a generic good news headline. But institutional desks view this through the cold, calculated lens of credit risk, supply chain logistics, and sovereign bond yields. The volatility crush. For the past 120 days, the global economy was pricing in severe structural tail risks. Specifically, a permanent disruption to the Strait of Hormuz, sky-high shipping insurance premiums, and an energy shock that would force a hawkish Federal Reserve to keep interest rates elevated well into 2027. The moment the peace framework consolidated, those extreme tail risks evaporated from the pricing models almost overnight. The Bitcoin rebound loop. Bitcoin responded exactly like the high beta macro liquidity barometer it has become. After violently testing a terrifying local low near $60,000 earlier this month due to intense spot ETF outflows, BTC slammed into an aggressive short squeeze, surging 7% back to $65,000. Institutional market makers who had heavily hedged their downside via options desks were forced to aggressively buy back spot supply to rebalance their books, turning a geopolitical relief rally into a mechanical liquidity squeeze. The fear and greed paradox. Despite this rapid 7% price recovery, the underlying sentiment across X and trading forums remains far from euphoric. Why? Because smart money realizes that while the immediate geopolitical risk has cooled, the broader macroeconomic landscape remains highly complex. We are still operating in an environment where major banking institutions, including analysts at BNP Paribas, are openly forecasting structural inflation stickiness and warning that global rate cut cycles may be delayed or completely reversed by late 2026. The $65,000 baseline isn't a sign that a reckless bull market has restarted. It is a baseline structural re-anchoring. Bitcoin has proven its floor, but it is now competing in a completely different capital environment than previous cycles. This brings us directly to the single most discussed structural trend dominating YouTube analysis and portfolio manager commentaries right now: the great AI crypto capital allocation war. For years, digital assets operated in a silo. If an institution wanted to deploy capital into an asymmetric, exponential growth tech narrative, crypto was virtually the only borderless liquidity game in town. But in 2026, that monopoly has been completely shattered. Every single week, elite artificial intelligence labs are releasing advanced foundational models, multi-agent automated commerce protocols, and next-generation developer tooling. This has created an intense structural rotation. Sophisticated sovereign wealth funds, corporate treasuries, and endowment pools are actively evaluating crypto and AI on a direct binary scale. They are looking at the immediate, compounding productivity output of enterprise AI infrastructure and deciding to systematically reallocate capital straight out of speculative software tokens to fund high-growth AI compute acquisitions instead. Look no further than the utter despair echoing across r/Ethereum for the empirical proof of this trend. Long-term stakers are pointing out the shocking fact that while Bitcoin sits comfortably near its high watermarks, Ethereum has been completely ragdolled, sitting down over 32% relative to its value 5 years ago. If ETH had simply matched the baseline relative performance of Bitcoin or BNB this cycle, it would be trading well north of $4,300 today. Instead, it is languishing at a pathetic $1,720. Why is this happening? Because the historical narrative that Ethereum is the sole universal world computer is facing intense structural dilution. Capital allocators are looking at Anthropic's explosive enterprise scaling and decentralized machine intelligence networks like Bitensor, TAO, and realizing that raw computational layers are capturing the high-velocity dollar. The hard truth is that the market is refusing to pay a generic premium for theoretical decentralized consensus when it can deploy capital directly into the bleeding edge of the machine intelligence revolution. But while the legacy Layer 1 networks are experiencing a deep identity crisis, an entirely new structural monster has completely hijacked the on-chain trading metrics. Let's talk about Hyperliquid and the rise of hyper-performant app chains. The market does not care about your decentralization ideology. The market cares about speed, liquidity, and a clear link to token value. Hyperliquid has single-handedly captured massive trading volume by building what purists dismissively call CeFi in a bag. It operates on a highly specialized, hyper-performant Layer 1 app chain that processes an astronomical 100,000 orders per second. The technical reality makes maxis completely sick. Hyperliquid runs on just 27 active validators, with a mere handful of foundation nodes controlling a massive chunk of the active stake. Yet the user base is growing exponentially, because users don't onboard because a protocol is a decentralized masterpiece. They onboard because the experience is flawless. Unlike legacy protocols that allow venture capital firms to dump billions of dollars of high FDV paper, Hyperliquid did a massive, clean community distribution. 97% of transaction fees are routed directly back to token holders. They literally cornered the market by strong-arming stablecoin issuers like Circle, capturing an astounding 90% of all USDC treasury yields generated on their chain. The platform behaves less like a standard crypto token and more like an aggressive 24/7 borderless competitor to Robinhood, Coinbase, and the Nasdaq itself. Let's bring it all home to the definitive structural verdict on the capital reallocation trends of June 2026. The noise. The geopolitical peace deal means everything is safe. The crypto bull market is back on track, and you should blindly buy laggards. The signal. The macro landscape has structurally decoupled. De-escalation has established a floor for Bitcoin at $60,000 to $65,000, but the capital is now highly segregated and intensely competitive. If you are allocating capital today, you must accept that crypto is no longer trading in a vacuum. It is locked in an intense generational capital war with the artificial intelligence sector. Position your portfolio where the actual economic velocity is concentrating. Look to high-performance app chains and decentralized compute infrastructure that directly services the global AI transformation. The old retail waterfall is dead. The institutional orchestration layer is live. Stay sharp. Stay focused. That's it for this definitive weekly edition of the Signal and Noise podcast. My name is Newell. Do like and subscribe. We'll see you on the next block.